Hey guys, it's Sasha. Yesterday, the Federal Reserve increased the rates by 0.75%. This happened just after inflation accelerated, with May CPI data coming in at 8.6%, way above analyst estimates, and the Fed continues to show a baffling level of incompetence. The official position was that June's interest rate increases would be set at 0.5% for the last month and a half. 3 separate committee members as good as confirmed this about a week ago. It was evidently clear that this is way too slow. I have been making this exact point for some time, but for whatever reason that has absolutely nothing to do with politics or the looming midterm elections in the US, because the Fed is not allowed to make statements or take positions for political gain. So for whatever reason that absolutely, definitely, categorically in no way whatsoever has anything to do with politics, the Fed changed their mind about 2 days before the meeting and went for a 0.75% increase instead. To make sure that the markets don't completely lose it, the Fed chose to leak this information to the press in advance because, for no reason whatsoever, literally overnight, every single media publication out there decided that instead of a 0.5% increase that everyone was confident was going to happen, it will now be a 0.75% increase about 3 days ago, all at exactly the same time. Now, the official position is that the next increase at the next meeting at the end of July is going to be 0.75%. And of course, all the analysts and media are taking their word for it, and they all have independently come to exactly the same conclusion. It will definitely be 0.75% because, remember back in December, the Fed was still pretending that inflation is transitory, and the committee overwhelmingly expected that rates would stay below 1% all the way through this year. That was just 6 months ago. At exactly the same time, I was pointing out that this is incredibly stupid. If the Fed waits with the rate increases and waits for, a few months to try and not crash the recovery process, we might very quickly find ourselves in a self-propelling inflationary spiral like we have not seen for about 70 years. But the only real way to combat this and, not have to buy wheelbarrows to carry our cash around, other than praying and hoping, is to increase rates fast. And by March, the penny started to drop, but the distinguished bankers still somehow thought that a rate of just 2% at the end of this year is going to be just fine. That's going to be more than enough. Remember, this is after the Ukraine invasion. This is after we were already seeing ridiculous levels of inflation, the highest in 40 years. And in the last 3 months, the projection has now gone up by 1.5% to around 3.4% on average by the end of this year, which is still ludicrously low. And if you look at this projection chart and think something is a bit off, you are correct. Because according to the latest projections from the Fed, as of this week, they are still officially saying that as it stands today, rates will only have to go up to about 4% next year, by the end of next year, and then those rates will start falling back down. And inflation is already at the moment at 8.6%, which, in case anyone is not familiar, anyone listening from the Fed, is substantially higher than 4%. And that rate of inflation is still rising. Russia has started cutting gas supplies to Europe over the last couple of days, and the war in Ukraine looks likely to transition into a long and slow conflict now, which means energy prices this winter could look incredibly scary, especially in Europe. Food prices are already rising before we've even had the lackluster harvest in August and September. The food prices have already gone up by more than 10% year on year for the last several reports of the CPI data. But according to these projections from the Fed, inflation is still today apparently transitory and will still go away all by itself without the need to raise rates further. The rates don't need to go to anywhere near or even above the rate of inflation. It's just going to go and disappear all by itself. The Fed is also in the process of doing quantitative tightening, which they say should help alongside these rate increases. The big problem with quantitative tightening is that it has never been done before as an actual large-scale fiscal policy strategy. So the Fed has decided to prescribe experimental pre-trial medicine instead of tried and tested inflation-busting approaches, because tried and tested approaches have nasty side effects when you use them just after printing the most surreal amount of money in history and blowing up the government debt with zero consideration about the long-term implications of doing so. And according to that projection, the Fed themselves are expecting to do one more 0.75% increase later this year, the next meeting, but then only drop down to doing 2 lots of 0.5% increases for the rest of this year. year. So at the moment, with all the best information that they have at their disposal, they are still expecting to slow down the rate hikes this year after the next meeting. And even if you look at their own expectations for the benefits of this quantitative tightening policy, they're expecting to shrink the balance sheet from $9 trillion to $7.5 trillion in the next 18 months. So a pretty drastic course of action, given they were still stimulating the economy last week. But even their own projections as to the impact of doing so say that the impact should be equivalent to about 75 to 100 bips on the base rate, so roughly the same as that one increase that they did yesterday. The really big problem with quantitative tightening that I'm not hearing anybody out there mention is that it is a really slow result strategy if it does work. Quantitative easing is relatively fast. The Fed goes and buys a whole load of bonds and mortgage-backed securities off banks and essentially goes and deposits large amounts of money that they just made up into those banks' accounts. And then the bank is sitting there, they don't have all those securities they just sold, they have a whole load of cash, they don't know what to do with it, so they decide to go and lend it out. It is more likely, the rates are likely to be lower, they go and lend the money out to people and businesses, and hey presto, the economy is flooded with money, and people go and spend that money. That is the kind of theory. The quantitative tightening approach is much slower. The Fed can't just go to the same banks and confiscate the money they just gave them, or force them to go and buy back those securities that yesterday they bought off them. So instead, they have to wait for the bonds that they have to mature and then not replace them with new ones. So every month, the balance sheet will start trickling down bit by bit by bit, and it's going to be slow. At some point, the banks will start realizing, and this is not going to happen this month or next month, that they have a bit of less cash on their hands, maybe start tightening the lending policies. And remember, nobody knows exactly how this will play out over the next 18 months, so they're not going to be making decisions today based on a firm outlook of what the end of 2023 is going to look like. So the policy is very slow to take effect. There is one thing that could theoretically save the Fed though, and that thing is a big-ass recession that could maybe turn into an ugly depression. And we are seeing signs already that one could be on the way, because if we get a bad recession, demand and productivity will both drop. And when those two things both drop, people and businesses will have less money to spend. As the economic situation worsens, banks will then tighten their lending criteria naturally anyway because of credit risk and things like that. And so you're going to get the same effect of reduced credit out there, reduced money supply, and reduced productivity, reduced demand without having to necessarily do other fiscal policy actions. And in the last few days, we have been seeing some of the hallmarks of a potential recession or even a depression coming in. The UK just published data saying that their economy has had 2 consecutive months of declining GDP. A load of companies are letting employees go, the textbook precursor for a depression. Tesla just announced that they're getting rid of 10% of their non-factory staff, Coinbase is laying off 18% of their workers, and many other crypto and financial companies are firing thousands upon thousands of people because the crypto market has collapsed and other financial repercussions of that. Redfin and Compass have just let go of 900 people. All of these job losses have been announced in just the last 48 hours or so. And so perhaps what's really happening behind the scenes is that the Fed is expecting, or perhaps even hoping, that a market crash and a big scary recession will do their job for them and cut spend and kill inflation in the process. This could work in theory, although Turkey have kindly offered to be the guinea pig and test this on their own economy to see what happens when you don't increase rates to battle inflation and instead decide to just continue keeping them low, despite everyone telling you to do the exact opposite, and instead hope that maybe the recession helps you out. And Turkey's example is seeing inflation hit 73.5% in the latest data and still rising. So, although this scenario is unprecedented, the likelihood is that we're still just getting started with whatever is coming later this year or next year. We're still only 6 months into this stock market crash, a relatively short period of time, and we've only just crossed the 20% mark, well short of the 50 to 60% mark that some of the previous ones have gone to. And there is every chance that we're not even halfway down yet. But the most important fact is this: I do not know, and neither does anybody else, where this thing is going to go. And the worst thing that you can do in investing is make decisions based on hunches or guesswork. A lot of retail investors make this mistake. They think that if the economic outlook is negative, then why would you stay invested in the market? Surely the correct, the smart decision is to sell all your stocks and wait until it's going to hit the bottom if you genuinely believe that things are going to get worse. Well, no. Imagine you are doing a coin flip and you think that there is an 80% chance that the coin will land heads. If you decide to gamble and call heads, you have a pretty reasonable, pretty good 80% chance of getting it right and winning money. But there is also a 20% chance that you will not get it right. And the risk here is that if you don't get it right, you risk losing more money than if you win. So if you feel, for example, there is an 80% chance that the recession and high inflation scenario does play out and you time it right and you get it right, you might be able to get, I don't know, maybe 20% or even an extra 30% on your investments, given that the stock market has already sold off by such a large amount so far. But if you are wrong, if the 20% scenario plays out and the market bounces for whichever reason, you might lose 50% or 100% or even more in terms of gains on some of the stocks that you hold that have already sold out instead. And when you multiply the likelihood of a scenario playing out, so the 80% or the 20%, by the severity of the outcomes in each of those scenarios, you quickly realize that just because something is more likely to happen does not mean that mathematically you should necessarily bet on it. But then remember that as an investor, you will have to make this kind of call a lot. There was a crash in 2020, and if you sold out trying to time that one, you would have lost a giant amount of money as the market immediately rebounded. There was another drop in 2018 that didn't actually go all the way down, so if you were waiting for it to go down, you would have missed out too, and so on and so on. If you take that 80%, for example, likelihood, whatever you decide it is, and you have to make 10 decisions over your investing career where there is an 80% chance of you getting it right, you only have a 10% chance that every one of those 80% likelihoods will come in. If you are in your 20s, 30s, or 40s, and you have maybe a longer window in which you're going to be doing your investing, and you have to make that call, for example, 20 times in total in the future over the next many, many years, the chance of it coming in every single time, even if each one is 80% likely, is 1%. And I don't know about you, but I don't like the odds of 1%. I don't know which way the market will go, even though I can make educated guesses on macroeconomic scenarios playing out. The one thing I do know is that the sales are still going, and my personal plan is to load up as much as possible while the stock prices have been absolutely smashed to pieces by factors that in many cases do not affect the long-term fundamentals. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching, I really appreciate it, and as always, I'll see you guys later.